Hi, everybody. Thank you so much for coming to the class today. I was thrilled that Tanya asked me to teach this class on first-time home buyers, and I'm just hopeful that I can give out some good information and help people or help you guys grow your business and help first-time home buyers get into their homes. I am a single mom. Opened my own brokerage a couple of years ago. Before that, I worked for my brother-in-law at his brokerage and just realized that I was giving away a whole lot of money that I didn't need to give away. So I opened my own brokerage, and here I am sharing my success and teaching success to all of my teammates. So I'm excited to be here. Thank you, everybody, for coming. So the first thing I wanted to talk about, I have a whole list of things. I have some slides I'm going to show, but I want it to be interesting and interactive. So the first thing is I put on my brightest shirt I could today because I'm a little extra, and I wanted people to know that, just know that about me. I'm a little extra. So I put on my brightest shirt. Okay, so the very first thing is I want to say that lenders, please remember this, lenders are not realtors, and realtors are not lenders. So although we can give out information and do the best we can, we don't take the place of one another. So I am so excited to teach you some things on first-time home buyers, but there should never be a time when realtors give out rates. There should never be a time when realtors are saying, oh, you know, if your debt to income ratio is this, you'll be able to get approved for this. I had to study hard and pay a lot of money and get my license to be able to give out pricing, give out rates, give out that information. So if you are ever in a situation where people are like, well, what is the rate? You can say, well, generally, from what I understand, the rate is this, but you cannot say you're going to get this rate because it's just not your place. As it's not our place as lenders to say, oh, well, you should offer $5,000 more on this house. You know, that is not our place. And so the best piece of advice I can give you is find a lender that you can partner with, that has your back all the way, that you can call 15 times a day, 20 times a day if you need to, and ask them questions, put them on speaker with your clients and say, hey, Tiff, you know, this person has, they think they have a 720 credit score, they're, you know, a VA borrower, what do you think? And then at that point, I can, or whoever you work with, can give out some really good information on rates and pricing and stuff. So partner with a lender and partner with a great lender. I want to go into showing you the first slide I have, which is, let's see. So everybody should know I'm kind of new at the screen sharing thing. I'm 46. My kids do all of this for me, so this is new for me. But can everyone see the slide?
Yes.
Okay. So I want to talk about using a broker versus using a bank. My office is a brokerage, and many of you already know the difference, so I don't want to bore you with that, but some of you may not know the difference. Big banks and corporations, they have many different charges that brokers don't have, which is my next slide. But we, as brokers, we provide faster closings, we provide better service, and we typically provide lower rates. A lot of times, banks and credit unions will say, oh, we don't have the fees that the mortgage brokers have because you carry your checking account with us, or you carry your car loan with us, or you carry all of these things with us, so we don't have those fees. But they do have those fees, and they do build them into their pricing because they have different levels of people they have to pay, which I'll show you in a second. As a broker, we do shop multiple lenders. I have 73 different lenders that I can shop. I know I do a lot of studying. I know on any given day, basically the top 5 of every day, who's giving the best rates, who's giving the fastest closings, who's giving the best service. Most brokers are going to have that information. Banks and credit unions have their product and their product only, where mortgage brokers have a whole plethora of products. We always can get you to the closing table faster. I don't know how many times I've heard, gosh, this bank or this bank, Navy Federal, USAA, US Bank, Wells Fargo, they're taking 60 days to get us to the closing table. And that is not normal. You know, we take anywhere from 15 to 20 days. But of course, if the buyer needs 30 or 45, we can do that too, no problem. We do offer wholesale interest rates. So what's interesting about that is if you have a Sam's membership or a Costco membership, you kind of get like the wholesale deal, and you can buy things in bulk. We were talking about it yesterday. Toilet paper is so expensive. If you go to like a King Soopers or whatever, you're paying $15 for 12 rolls of toilet paper, where if you go to Costco, you can get like 36 rolls for $20. So it's kind of like that. We get our money for less money, basically. So we can give it away for less money and a better interest rate. We're truly and honestly experts at mortgages. This is all we do. We live it, we breathe it. This is all we do. We do have different technology that lets your buyers apply for mortgages online and track their loan progress all the way through. I know some banks have that too, but it's just nice. We are a local business, and literally we are the small business. You know, we're a mom and pop shop. There's 6 of us. We're all local. And by sending your buyers to us or any broker, you're supporting local. So that's really important. Okay, let's do slide 2. Okay, can everyone see that one?
Yes.
Oh my gosh, I'm on a roll. That's awesome. Okay, so here's where you can look and see the differences between why we save people money. Okay, so if you're going to a bank, they have to pay their CEO, they have to pay their vice president, they have to pay their regional manager, they have to pay their branch manager, they have to pay the loan officer, and then you get down to the buyer. So what do you think the loan officer is making? I promise you, in a bank or a credit union, they're not making very much money. So their interest in the client is going to be less than what a mortgage broker is. The branch manager probably never even talks to the client. Regional manager definitely never talks to the client. Same with the vice president and CEO. So you have a whole lot of people in line to get paid, and they don't even ever know the client. Okay, so that's just not a good setup. For a broker, and again, I'm a broker, there's the buyer, there's me or the loan officer, and then there's the business, right? So the only people who get paid with a brokerage is the loan officer and the brokerage. So you cut out a whole lot of costs. And in my brokerage in particular, we have weekly meetings where we discuss everyone's loan that we have going on our books, so that at any point in time, if I'm out or someone else is out, someone in the office who is a licensed loan officer can help. So that's usually with most brokerages. All right, let's talk about first-time home buyers now that I've given the spiel about brokerages and about how lenders are not realtors, realtors are not lenders. All right, so with first-time home buyers, they are my favorite, and I think a lot of realtors would say the same because of the excitement that they get out of the first-time home buyers. And sometimes it's hard because they're scared, but if you love on them and just, you know, make sure that they feel comfortable, you get to the closing table and it's the happiest day of their life. So having the right partner, meaning real estate agent and broker, makes all the difference, right? You're getting that personalized service. So I always say, send your clients to a broker, and I promise I won't try to say that a whole lot more, but it's really important. For the first-time home buyers, we have a ton of programs. And this is just a few that we have, listed here, but we have the 1% down, 3% down, 3.5% down, and 5% down. A lot of times families will say, well, we want to gift a certain amount of money to get them started. Nowadays, that's very common because homes are expensive. So parents are able to gift their kids a little bit more money for down payment. We have loan programs that we can do with credit score starting at 620. Now, I do not advertise that I can go down to 585, although I can. The reason I don't advertise that is because as a broker, we are financially responsible for the loan for 6 full months. So if we get someone into a home and they don't pay their mortgage for the first 6 months, we get in trouble. So I will give a loan to somebody with a 585 credit score, but that's after a lot of counseling. It's after a lot of, I'm not a financial counselor, but it's after a lot of discussion. And hey, can you really afford this? Can you do this? Or should we work on your budget? Should we work on seeing if we can get you some more income so we can get you into a better situation? Again, I'm not a certified financial counselor. I'm not a credit repair person, but I can help with all of those things. And so can anybody here in my office. We can close in as little as 20 days, as I talked about before. We do 100% gift options. So if a parent wants to gift 20% down, if they want to gift 5% down, if they want to gift $5,000 and their son or daughter wants to do the rest, that's fine. We also have a gift of equity. So let's say the parents own a home and they want to have their son or daughter borrow it or buy it, they can give a gift of equity. So if there's a bunch of equity in that home, they can say, well, we're going to give them $100,000 out of the equity we have. So then the buyer isn't coming to closing with any money whatsoever because all of that's covered with the gift of equity. We also have the down payment assistance programs. Now, as the market gets tighter, those get harder to give. And the reason why is because for the down payment assistance programs, in order for the broker or the loan officer to get paid, we have to have a pretty good chunk of seller concessions. And right now, I would say we're still at that area where we can have a decent amount of seller concessions, but man, they're going away quick. We're seeing even over this past weekend, multiple offers, $10,000 over asking, $15,000 over asking in the Denver market. It usually takes a month to get down to us from the Denver market. So I just pray that we have those for a little while longer because I love those seller concessions. They're helpful for loan officers. They're helpful for borrowers. They're helpful for realtors. So we'll see. We do have those down payment assistance programs. So to learn more about that, let me know. I promise you the down payment assistance programs are not as good as they sound. There is more to it than, hey, we're going to get assistance with down payment. So we'll move on to slide 4 here.
Can I just add something to that? So maybe you can add like the down payment assistance programs. Like you said, they're not as good as they sound, but also in a low inventory market, right? You need to come in really strong.
Yeah, that's true. Yeah, and so if you're coming in with a CHFA loan, because you do have to disclose that when you're as a realtor, that what kind of loan it's going to be. And if they have a conventional offer or an FHA offer or a VA offer, they're most likely going to take one of those before they take the CHFA. So yes, that's a good point. That's a good point. So slide 4, this is just a really good document to kind of take a photo of and say, hey, these are the kinds of things you need to have in your pocket and be ready for as a homeowner. There's closing costs, which right now we are getting some closed or those covered by sellers. Again, we have probably 30 days or so. You're going to need a down payment, which we already talked about on the slide right before this. We can do 1%, 3%, 5%. There's tons of different things. Earnest money, appliances and furnishings, especially on those new builds. Those new builds are you know, they're offering a 3.99% interest rate or a 4.99 interest rate. But people forget, like, you don't have window coverings, you don't have shower curtains, you don't have rugs, you don't have so many of the things that you have to spend money on to get to where that home is really livable. Maintenance, there is certain maintenance that has to be done on homes, and people forget that too. If they don't want any maintenance, obviously a condo or a townhome is the way they want to go. Property taxes, as we know, and as we talk about as a mortgage broker, we have seen property taxes go up a lot these past couple of years, and people were not prepared for that. And I say people, our people were prepared for it because we told them, hey, you're going to get an increase in your mortgage because property taxes are expected to go up. I was listening to one of my mentors this morning. His name is Barry Habib, and he said that consumer confidence is at the highest level it has been in the last 2 years, which is great. But that also means that people are buying. If they're not prepared for what's coming, then that's going to be bad 2 years down the road. And then, of course, insurance. Insurance also, those of you who have sold homes in the last couple of months, you know, probably the last 6 months, 8 months, you know, insurance has doubled for homeowners. So we're having to be very careful about what we're approving our buyers for, because we have to put in quite a bit for property tax now. We have to put in quite a bit for insurance. Another thing that a broker does that a bank doesn't do is we have partners that we work with in insurance, and we'll call them and say, hey, how much would it cost to insure this house for this person with this credit score? And typically they can give us a really good idea. So then we can offer that to the client and say, hey, we have 3 different quotes for you, call these people, whatever, or they can call whoever they want, but it's something we do. So this is just good to have and let your buyers know. I pulled this off of Canva because I thought it was so funny. So the home buying process in 7 steps, it's super easy, right? So the first thing is check your credit score. And it says 800. Let me tell you, we have like 2% people that have an 800 credit score, you know, that come to us. Like, it is not a lot. And when it is, we just jump up and down and we get so excited and yeah, you know, but it's funny. They don't know consumers, buyers, some of them do know how to check their credit score, but for the most part, they don't. And then it points to choose a lender and then find a real estate agent. I'm here to tell you, this is my dream, to have an 800 credit score and to have borrowers choose a lender before they choose a real estate agent. Oh, how I would love to give my borrowers to real estate agents that I love to work with, but it doesn't happen that way, right? Like, the very first thing is they find a real estate agent. They talk to a real estate agent. And then maybe they talk to a lender if that real estate agent is really smart and directs them to a lender. And then maybe they can get information on their credit score. And then sometimes the journey ends there, right? Like, that's it, because we have a 500 credit score, we got a lot of work to do. And then, but if they don't, let's say they have found a real estate agent, they've found a lender, their credit score is good, then they can search for homes. And that's where you guys come in and things are so crazy for you, because then you're showing and doing all of those things. The home appraisal and inspection, the inspection is typically something you guys offer to help them with, helping them find an inspector. And then the appraisal is always ordered by the lender. So nobody should ever think that they have to, you know, be able to order that appraisal. It has to be ordered by the lender. Something I want to touch on that really quick. If you go to a bank or a credit union, they have a panel of appraisers that they can pick to go out to these properties. So they can say, hey, Bob Smith, I'm going to pay you $600 to go appraise this home. Well, Bob Smith can take the $600 and he can go appraise that home, and then he can give it to the bank. The bank has no say in what Bob Smith appraises that home for. Brokers, however, we are not even allowed to talk to the appraisers. We do not have appraisers on our staff. We have to go to a pool where we basically hire an appraisal management company. You'll hear that a lot, the AMC. We have to hire an appraisal management company, and they choose the appraiser, and then that appraiser gets to go do their thing. But we can't even talk to them. If we speak to the appraiser, the appraisal is automatically void, and they have to start over. So that's a big difference between a bank and a broker. You should know, brokers aren't allowed to talk to the appraisers, where banks have a whole staff. And so typically they can charge less because they're paying their appraisers less money. Right now, banks are charging about $600 for appraisals. We're charging $675 because $75 has to go to the appraisal management company, $600 goes to the appraiser. And then you make your final walkthrough, and then you close on your new home. I wish it was that easy, and I think you guys wish it was that easy too. Because if it were that easy, you wouldn't even have to be going and doing marketing, right? Like, you would be getting all of your business from lenders if you have good relationships with those lenders, right? It's so rare, you guys, that clients come to us first. And if you are partnering with a lender and you're mad at them because they haven't sent you a deal, but you've sent them 10, please reconsider being angry at them. Clients do not come to us first. Can we pay for leads? Sure, we can. We can pay for leads. But having been there, having done that, they don't want to talk to us first. They want to talk to a realtor first. So it blows my mind. But it is how it's like going to buy a new car off of a car lot. You don't want to check and see what you're approved for first and what your payment is. You want to talk to that car salesman and find the car first, right? So just keep that in mind, and please, it's disheartening when I hear realtors say, well, I'm not going to use that lender because they don't give me leads. I promise it's not because they don't want to. I promise we want to give leads. We want to do that. We just don't have the clients coming to us first.
Can I add something to that?
Yeah.
I think that is a really great point, because, so many realtors in this industry are like, what are they giving me? Right. And we always talk about having a reciprocal relationship with your lender and your service partners, but reciprocal doesn't mean that they have to give you leads. First and foremost, you need to pick the lender that gives the best service, right? Mm-hmm. It's not always the best rate. It's the best service, right? Because you want to make sure that loan is going to close. And oftentimes lenders will say, I could give this rate, and they can beat people, but they're not even able to close the loan. So that's one thing. And then the second thing is reciprocal is, are they picking up your phone calls? Are they maybe helping you with social media? Can you go into their office and sit in their office and use it as an office and not pay for office space, which Tiffany has an entire office space that anybody could sit in. You can bring clients in. You don't have to pay for an office. And then now your client, it shows credibility because you're in a professional environment.
And it's not, and Tanya's right. We offer that to all of our real estate referral partners. And it's not like a little dinky office. It is a beautiful space where we say, pretend like it's yours, make yourself at home, use it. But yeah, Tanya, that's such a good point. Like, one of the things that I wanted to talk about that I was going to touch on at the end here, but I might as well say it now. Work with a lender who is trying to help you grow your business. Work with a lender that is saying, I'm here for you. I'm here to answer the phone whenever you need me. I'm here to offer you office space. I'm here to help you find classes where you can learn stuff. Don't work with the lender that's the most popular on social media or whatever.
And open houses. Some of you guys do open houses with people.
Oh yeah, we do all the time. We're busy with open houses every weekend, so we can go and do all of that. But Work with a lender who's available to help you grow your business and who genuinely wants to help you grow your business. I promise you, banks, credit unions, they don't give a rip whether your business grows or not. All they care about is the stuff that comes in. And these people who are slinging 100 to 150 loans a month, they don't care either. All they care about is, getting people in, and they can't personally touch it. I mean, we are, a group of 6 and closing 20 to 30 loans a month, and that's perfect. That's where we want to be, because we can touch everyone personally. We can help all of our realtors personally, and it's just the best thing. So work with a lender who's available to help you grow your business. All right, next.
Can I add one more thing?
Yeah.
So the one thing that was missing here from your 7 steps, right in the middle between search for homes and get a home appraisal, there should be make an offer and get an offer accepted. And I think that's where, as a great lender, you add the most value by getting that pre-approval documents and making that offer stand out a lot. So I think that's where you really, a great lender adds a lot of value there too.
I appreciate that comment so much, because I think that is one of the key factors for a lender, a key role for a lender to play, especially somebody who knows a lot of realtors. I know a lot of realtors in this area, and 9 times out of 10, when I call them, I'm like, hey, and I mean, we're talking a listing agent, we're talking about personal stuff before we're talking about the offer getting accepted. And they're like, oh my gosh, the pre-approval letters from you, awesome. We know they're good, So that is such a good point. Like I said, I pulled this off of Canva, and I really thought it was so funny, but I might remake this and put that in there, because that's really important. I love that.
Put your face in there.
Yeah, there you go. She's awful cute, that one. Okay. So I wanted to take 10 minutes to go over some of the very, very basic products, so that you guys who don't know about these loan products can get a good bit of information. Please take a photo of this, print it for yourself, whatever you can do. But there are 3 basic loan products that you're going to come in contact with almost every time. And that is the FHA loan product, the conventional loan product, and the VA loan product. Okay. Those are going to be 80 to 90% of your business. So the FHA loan product, really quickly, a lot of people think it stands for First Time Home Buyers Association. It does not. It stands for Federal Housing Association. All that means is that these loans are backed and guaranteed by the federal government. That's it. These are a lot of times geared towards first-time homebuyers, because their credit score on an FHA ranges anywhere from a 620 to a 680. Great for first-time homebuyers. They can get into this loan with 3.5% down. First-time homebuyers are people who've never purchased a home, or if they haven't owned a home in over 3 years. So a lot of people don't know that. Well, I owned a home 10 years ago, but I sold it. Well, then they're considered a first-time home buyer again. I needed to change this for 2024, so my apologies. The loan limit for 2024 on an FHA purchase is actually $517,000. The purchase price can be more, but the borrower would have to bring their 3.5% down, and that difference between, let's say, 560 and 517. So they have to bring the 3.5% down plus any difference. There is monthly mortgage insurance that is set up through the lender. It is required for anyone using an FHA loan, and it will stay on the payment for the life of the loan unless they put 10% down, but a good lender can talk to you about that at another time. Anyone using an FHA loan will that PMI or mortgage insurance will stay on for the life of the loan. Now, a good lender will contact that borrower in 2 years and say, hey, you probably have enough equity for us to get you out of that FHA loan. Your credit score is probably good enough now so we can get you into a conventional loan and get rid of that mortgage insurance. So as a realtor, it's great for you guys to remind us, hey, or remind your buyers, hey, an FHA loan is a great product. Does it have mortgage insurance? Yes, but it's a great product to get your foot in the door, get a low down payment, and then you can refinance into a conventional loan and get rid of that. So again, that's where the lender and the realtor, come into play as good partners. If they're buying a condo or a townhome, the development must be FHA approved. And if you are working with a good lender, they will check that before they send out a pre-approval letter. They will check to make sure that it's FHA approved before, or they'll say, this development is not FHA approved. So you'll have to go look somewhere else, or we'll have to do a different loan product. One of the things.
Can I just add to that really quickly?
Yeah.
So what she's saying, you guys, is if you put an offer on like a condo, right? Don't always expect your lender to know these things. You should also go and look for FHA approved condos in your zip code, and they usually list them, because what usually happens is you get through the loan, right? Or you get through the escrow, and like 10, 15 days in, they're like, this isn't FHA approved. And that house, that condo that your buyer fell in love with, now is not qualified, and it's a really horrible process for them.
Yeah, it is. It's sad. And that's why, again, working with a good lender, they're gonna be on top of that with you right up. And if you're listing, if you're making a listing, don't go in and say FHA approved, VA approved, conventional loan approved. Make sure you're doing the footwork to make sure that those loans are okay for that listing.
Well, and sometimes they take condos off of the FHA approval, right? So you got to keep up.
Oh, yeah. Every year. So condos have to reapply to be FHA and VA approved every year. If they don't, and they don't pay that money, they're taken off of the list. So yeah, it's important. One of my favorite things about the FHA loan product is we can go higher on debt to income. So we can go all the way up to 57% on debt to income, where on conventional, we can only go up to 50. So if they have a little extra debt and can't pay that off before they buy a home, an FHA loan is a great way to get them into a home without having them have to pay off a bunch of debt. And then once they do pay off some debt or gain some equity, we can refinance them into a conventional loan.
Can you repeat that? It sounded like you just said 50 and 50.
I'm sorry. Okay, so the FHA loan, debt to income, cannot exceed 57%. The conventional loan cannot exceed 50%. So if they have like an extra debt, an extra car payment or something, and it puts them over that 50%, we can put them into an FHA loan, and then a year or two down the road, when they have more equity in their home or other debts are paid off, we can refinance them into a conventional loan and most likely get that PMI taken off or lowered quite a bit. All right, so the next one is the conventional loan product. I'm so sorry.
Can I add
about
something?
this. Yes. Yes.
Sorry, on the FHA. So I'm in California, so I'm looking at $470,000. I'm like, I cannot even buy a shed for that here in Southern California. So just wanted to share that there's different FHA loan limits for different counties and different states. So if you're in a high price area, the loan limits will be higher, but your loan officer obviously can share that with you.
Thank you. Again, that's really good input. I didn't realize we had people outside of Colorado here. But we do have high balance counties here. Douglas County, if you're selling a property in Douglas County or the Aurora area, those are high balance counties. So those, the amount of FHA loan that you can get over there is higher than in El Paso County or Pueblo. So again, great reasons to have a good relationship with your mortgage broker or loan officer. Conventional loan products, the credit scores typically range from 680 to 800 plus. For the first-time home buyer, they can get into a conventional loan with 3% down. We do have a 1% down program. Basically what that 1% program, 1% down program is, it is a conventional loan, and we will pay up to $4,000 in grant money that we have to go towards the down payment. But it ends up by being a little more than 1% for the borrower, because $4,000 isn't going to cover, you know, the difference. So anyway, we can talk about that. That program is really deep in depth. So we're just going to go over the basics here. Plan on your first-time home buyer getting into a conventional loan with 3% down. Again, the first-time home buyers are people who have never purchased a home or haven't purchased a home in more than 3 years. If your borrower is not a first-time home buyer, they can start with 5% down and go up from there. They can put 10, 20, 30, 50, whatever they want. Monthly mortgage insurance, which is set up through us, is required for anyone using a conventional loan and putting less than 20% down. So if they're putting down 15%, that mortgage insurance is probably going to be $25 a month. If they're putting down 10%, it'll be $50 a month. If they're putting down 5%, it'll be $90 a month. Like, it just, the more they put down, the less that mortgage insurance is, okay? There's such a common misconception about the conventional loans and that they're required to have 20% down. Absolutely not. That's only if they don't want to pay private mortgage insurance. But if you're telling me that you have 10% down and you're not willing to pay $50 a month in mortgage insurance, and you're willing to wait another 5 years to save up that difference for down payment, you're losing, because you're going to be paying a lot more money in your house payment waiting for 5 years down the road just to save up that 20%. Debt to income can't exceed 50%, and many times it's capped at 47%, depending on credit score and compensating factors. This loan is not an assumable loan. Okay, and then the next one, let's see.
Blessing
Yeah.
has a question.
Oh, yeah.
Hi, Tiffany. How are you?
Hi, I'm good.
Fabulous. I had a question about the mortgage insurance. So, of course, as you said, it is anything, the mortgage insurance will be on any loan product that a down payment of less than 20% was applied to the purchase. How long does that mortgage insurance stay on? Does it automatically fall off once the 20% has been paid into the process, or does the buyer need to then refinance, or how does that disappear?
It's such a good question. So let's say I've owned a home for 2 years and I feel like I have 20% equity in my home, and I should be able to not pay that mortgage insurance anymore. What that homeowner is going to do is they're going to call whoever is servicing their loan. So in other words, whoever they get their monthly statement from, and they're going to say, I want to drop the mortgage insurance off. How do I do that? Most companies will say, okay, we can do that, but you're going to have to get an appraisal. And then the servicer will order an appraisal to make sure that that 20% equity is there. So that's one option. Option 2 is, yes, we could do a refinance, and that would get the mortgage insurance off. It possibly could lower the rate. So there's a couple different reasons to do a refinance. 2 years or 3 years later, drop off that mortgage insurance, lower the interest rate. If you had enough money to cash out, whatever. There's several reasons for that. Or number 3, you can sit on the loan and it'll fall off on year 11. Okay, that mortgage insurance will fall off year 11. So there's those 3 options. Call the servicer, call your broker to see about refinancing, or wait and it will fall off.
Was this specifically for the conventional loan or for all loans?
Specifically for the conventional loan. That does apply to the FHA loan if they're putting 10% down. But I don't like to mix those up, because most of the time when someone's using an FHA loan, they're not putting more than 10% down. Makes sense?
So to continue that, so if the mortgage insurance will fall off at year 11, does that mortgage insurance then get applied to the principal? Does it get applied to interest, or is that just money that's being paid that doesn't necessarily need to if the 20% equity's already been met?
You're absolutely right. It's like paying car insurance. You have to pay it, but if you don't use it, it doesn't, you don't get a check back at the end of the year, right?
Correct.
So if I never, ever recommend that somebody wait the 11 years in our market. Now it may be different elsewhere, but in our market, I'm saying you're going to have 20% equity in 2 to 3 years, maybe less. So as a good lender, I'm keeping an eye on all of my clients and I'm calling them and saying, hey, you probably don't need to be paying this payment anymore. Let's see about getting it off. And that's whether I make money or on a refinance or I don't, and they call their servicer. As a good lender, that's what I'm doing. And again, I promise y'all, banks and credit unions will not do that. They won't do it. But we, as mortgage brokers, as that small mom and pop shop, as that small business, we want to retain those clients. So we're doing everything we can to stay in front of them. Really good questions, though. I like that. VA loan, again, I'm really sorry I didn't update this. The current county loan limit for El Paso is $766,550, I believe, off the top of my head. And again, Martin said it earlier, that is different in high balance counties. So in Douglas County, in California, in Vail County, whatever, that limit is much, much higher. But in the general regular county, El Paso County, we're at 766. That blows my mind that anything under 766 is not considered high balance. It's not considered, it's not considered a jumbo. Can you imagine? Like, I know I'm old, but I'm like, dang, back when I was a kid, somebody who lived in a $750,000 house was a multimillionaire. You know, like, I can't even imagine. That tells you right there how much home pricing and has gone up, how much homes have appreciated, in the last 20, 30 years. It's crazy. Now somebody who lives in a $700,000 house, they're really very mediocre. California, they might be low level scum. I don't know. I don't know, but it's just different everywhere. VA buyers have a little bit of a misconception, and as their realtor, I beg of you to explain to them, you do not have a down payment. However, you do have to have money in your bank to buy a home as a VA member, right? You have to put down earnest money. You have to pay for that inspection. You do have to pay for closing costs if the seller doesn't pay for those. So yes, there is no down payment, but you still have to have money, right? We don't want to put somebody into a house if they have $4 in their checking account. It's just not good business.
Right? Can I add to that?
Yeah.
Real quickly? So when you have a VA buyer, exactly what she's saying, a lot of people will tell them you could buy a house and you don't have to have any money, and you could put $1,000 earnest money deposit. Okay. In a market like this with low inventory, and if you want your buyer to win a house, right, and win the offer, you need to encourage them to put more money of their earnest money down. The thing is advising a buyer to go in. A lot of these buyers have a lot more money to put down as a deposit, but some realtors are just advising them so poorly. No, it's okay. You can go in with $1,000 when maybe they have $10,000 to put down. They're going to get it back, right? They're not going to win the offer that way.
Mm-hmm. That's true. Again, that's a great reason to have a good lender on your side, a good lender partner, because that lender partner is going to call the listing agent and say, hey, these guys are very well qualified. These are their compensating factors. This is why they have to put a little bit of earnest money down or whatever. Partner with that good lender, guys. It's going to change your whole life, I promise. My favorite product is the VA loan product because it is just my favorite. There are so many great things to it. Comes with a much less a much lower interest rate than usually all of the other ones. You don't have that down payment requirement. Your debt to income can go all the way up to 74%. You say, is that smart? And as a lender, I promise you, again, we're looking at the entire picture and saying, I know that this is going to be 73% of their income, but we also have a BAH factor. We also have a BAS factor. We have jump pay. We have COLA. We have all different kinds of things that we can take into consideration for extra pay. So we know where they're going to be comfortable and where they're going to be financially okay.
Tiffany, there's a lot of VA loans that are advertising that they're assumable.
Yeah.
So if somebody wants to assume a VA loan.
Yeah. Here's what I'll say about that, you guys. Every VA loan is assumable. Your buyer does not go through a mortgage person or a lender to do that. They have to get the mortgage statement from the current homeowner and call that servicer. And they have to call and say, hey, can I qualify to assume this loan? That bank or credit union or lender, if they're busy, they're putting that on the bottom of their pile because nobody gets paid to do that work. Realtors get paid because they showed the house, they're listing it, they're selling it, so that's great. But lenders, nobody gets paid on those assumables, not $1. So that's the last thing they want to work on, is something that is going to take up a lot of time for no pay, right? So those loans are assumable, and that is literally a whole nother class, but you have to go through the current servicer for that. All right, let me see if I can get to my next slide. Sorry, I was doing so good, and then, oh, here we go. I want to talk about the 2-in-1 buy down, because this is something that Tanya asked me to talk about, and she said, will you really make that the focus? And I said, I can't, because it is so, there's so much more to the fundamentals of loans. This 2-in-1 buy down is a blip in our time right now, that it's great to learn about it and it's great to know about it, but it's not going to be around for much longer. Okay, let me explain what the 2-in-1 buy down. First of all, if you were to get into an interest rate today, this does work for FHA, VA, and conventional, by the way. If you were to get into an interest rate today at 6.5%, for the buyer, months 1 through 12, their monthly payments would be at an interest rate of 4.5%. That's a good savings. Like on a $400,000 house, $450,000 house, that's like $500 of savings a month. It's big. Months 13 through 24, the interest rate would be 5.5%. And then months 25 through the life of the loan, the interest rate would be at 6.5%. The goal here is for the lender in months 13 to 24 to refinance that borrower into an interest rate that's hopefully between 4.5 and 5.5, because they want to get that loan refinanced into a permanent rate for the life of the loan that's not 6.5. Is everybody following that?
Yeah.
Okay. The 2-in-1 buy down comes at a cost. The seller of the property must give a large enough seller concession to cover that 2-in-1 buy down. It cannot come from the borrower. It cannot come as a realtor credit. It has to come from the seller. The cost varies from loan amount to loan amount and the initial interest rate. So if the initial interest rate is 5.75, the buy down is going to be a little less expensive. If the interest rate is 6.5 or 7.5, it's going to be more expensive. Okay, so it varies. So you can't really ask a lender, well, how much does it cost for a 2-in-1 buy down? It is so dependent on loan amount and initial interest rate, and that initial interest rate is dependent upon credit score and debt to income. So there's so much to it, right? But I'm going to give you a generalized idea. For a $400,000 home with a 6.5 initial interest rate, the buy down would cost approximately $9,600. Okay. So you would have to get a seller concession for at least $9,600. Okay. For a 700, now please don't take my word to the bank here. This is very generalized. For a $700,000 home with a 5.75 initial interest rate, the buy down would cost approximately $17,000. So that's when you need to talk to the seller and say, hey, we need a seller concession of $17,000, $20,000, whatever it is to cover that buy down. And again, that goal is to get the borrower refinanced into a permanent lower rate before they hit year 3 and have to pay that higher interest rate. Now you ask me, if there's a seller concession of $17,000 or $9,600 and they refinance on month 13, what happens to all that money? Because there's still that concession that paid for the buy down. What happens to that extra money? Well, that extra money goes to buy down their principal. So they don't ever lose that money. It is sitting in their escrow account with the bank, and they don't ever lose it. So if we refinance them on month 13 into a 4.75, and they still have $10,000 in their escrow account for the rate buy down, that goes towards a principal reduction. Okay, so they don't lose that money. That is how those 2-in-1 buy downs work in a nutshell. Those are going away quickly. I can tell you, a week ago, I had a contract in here that we were getting a 2-in-1. This last weekend, we weren't able to get a 2-in-1 anymore. We were only able to get a 1-0. Same concept, right? But it's only for 1 year. So with the 1-0 buy down, the interest rate today would be 6.5, where months 1 through 12, the interest rate would be 5.5. And then months 13 through 24, it would go up to 6.5 again. Now that is about half of the cost of the 2-in-1 buy down. Okay. So right now, those 1-0 buy downs are big. They're a big deal. They're helping people. Does anybody have any questions about that 2-in-1? I don't want to move forward until I answer all of your questions.
Yeah, really
Yes, I
quickly.
do.
Can you, hold on 1 second, Alice, because this might help you. Can you let us know how they are, what you're seeing out there and how they are getting accepted? How are the buyers writing their offers and the agents presenting them for these 2-1 buy downs and 1-1-0 buy downs getting accepted?
Thank you. That's a good question. If you have a house, if you have a house listed at $500,000 and you love it, and your buyer is like, I really want this, but I really want the 2-in-1 buy down, go in and offer $510,000 and ask for the $15,000 for the buy down. Okay, so go in and offer a little bit higher. Say we're going to offer $510,000, but we're going to ask $15,000 in seller concessions. So the buyer's only really giving $5,000 from their initial price point. I'm telling you, in the last 2 months, the appraisals are coming in. We have not had an appraisal come in low or at par for a while, for probably the last 2 months. They've all come in quite a bit higher than purchase price. So that's going to work probably for another month, maybe 2. So you have a kind of a smaller window. Talk to your lender though. Talk to your lender, say, hey, what if we offer $510,000? How much do we need to get in seller concessions? You know, maybe you only need $11,000. Then the seller's only getting $1,000 less. You know, talk to your lender. I cannot even pound it into people's heads enough how important that relationship is. It's so important. It's like a marriage. You know, you can have the best partnership and a great marriage and everything just kind of works out. Or you can have a real shitty partnership and nothing works out, right? So have a good partnership. So I love that question, Tanya, because there's ways to get that 2-in-1 buy down still. And it's the same for the 1-0. You know, if we have people coming in $10,000 over or whatever, offer $10,000 over, ask for a $5,000 concession for that 1-0. talk to your lender. There's definitely ways that we can help. Let's say you have a seller, and they're like, how can I get my home sold? It's been sitting on this market for 30 days and everyone else's is selling within a week. Have your seller offer concessions right off the bat, say in your advertising, we're offering concessions for the 2-in-1 buy down. We're offering concessions for the 1-0 buy down. It puts the buyer in an ideal situation with a temporary rate buy down, saving them money for the first 2 years. And here's a good rule of thumb. Having your seller offer approximately 2% of the home price as a seller concession allows the buyer to go down 2% on their interest rate for the first year and 1% for the second year. So that's for the 2-in-1. If they're offering 1%, that's for the 1-0. That's a very generalized percentage, but it'll get you where you need to be, okay?
Love it. Alice has a question, and then Martin has a question.
Okay, sure.
Okay, my question is, why are they doing 2-in-1 buy down? Why not just give, say 10,000 or 15,000 off of the price?
That's a great question. I will tell you, in the long run, I've done the math back, forth, up, and down. In the long run, it does save the buyer a lot more money to lower that interest rate 2 entire percent that first year and 1% that second year than if they were just to lower the price by $10,000. They're saving $17,000 in payment or $15,000 in payment. So the reward is bigger than lowering the price. The reward is also bigger than doing a permanent rate buy down, because those are more expensive. So if a seller wanted to give a $10,000 concession for a rate buy down, your 2-in-1 is going to be better than doing a permanent rate buy down, because you're only going to get 0.25% or maybe 0.5% on a permanent. And to me, it's a waste of money, because once that permanent is spent on that buy down, it's gone. But on the 2-in-1 or the 1-0, it's still sitting there in that escrow account. It can still be used for that principal reduction. So I'm coaching my clients and my real estate partners, don't tell your seller lower the price or do a permanent rate. Tell the buyers to do a permanent rate buy down. Do the 2-in-1 or the 1-0. It's the better bang for your buck. Good question.
Got it. Thank you.
Yeah. And
Martin.
who else?
This is my turn.
Yeah.
So why do you see this this program going away? Is it because expected competitiveness in the market?
Yeah. So we saw rates went down almost an entire percent. And when that happened, we saw approximately 5 million buyers and re-enter the market because they could then afford it again. Yep. As more buyers enter the market, the competition is heavier. Because we live in Colorado Springs, we have 5 military installations here. And our biggest PCS season is June. We also have a PCS season in February and October. But the people who are PCSing here in June, they are on the hunt for houses right now. So we have a big influx of buyers right now. And so the competition is just heavier. And sellers aren't having to offer that because more people want their homes.
Can I add to that?
Yeah.
So even though the sellers don't have to add to that, if you do have, maybe you can speak to this, if you do have a solid loan and a buyer wants to still ask for that, right? You could still ask for that even if it's not this type of market. Can you speak to that? Yes.
I mean, you can absolutely ask, for whatever it is you want. If you have if you're doing a good job as a realtor, you're keeping up on what's happening in the market and you're advising your clients, you can offer whatever you're comfortable with, and I will take that to the buyer. But I want you to be prepared that it may not get accepted because there may be other offers that are coming in stronger. They're not asking for seller concessions. They're not doing this. So just prepare your clients. If they're prepared and it doesn't come as a surprise, you're still going to, even if they don't get the deal, they're still going to love you because you warned them. Hey, we can offer whatever we want, but please be prepared that they may have a better offer because this isn't the strongest, you know, it's not super strong right now. Yeah.
One
yeah,
more thing to
so
add.
then I say, who wins? The seller wins because they sell their home. The buyer wins because they have a much better rate until they can refinance. Okay. The next one.
Oh,
yeah.
sorry. I was going to say, as a buyer's agent, you also want to call the listing agent to make sure that you understand exactly what your seller is looking for. So then you get your feelers out to see if they're even in the market for a buy down option or a seller concession. So
I mean, I think that is a piece of gold advice, because if you're not in contact with that listing agent and you're not asking them the important questions, then nobody's going to win. You're doing work for no reason. Your clients are putting in an offer for no reason. You know, be a professional, pick up the phone, talk to that agent, you know, get all of that information up front, because that's how you're going to win for sure. The last thing, I'm sorry, I went a little bit over, but there are certain things that as realtors, y'all should be asking your clients before you even talk really about what homes they want or whatever. I mean, you guys can do this however you want. I'm not saying to change your whole presentation, but I do have a few realtor referral partners that I never get clients that are not pre-qualified, right? Like, they come to me and they're good buyers because their realtor has asked these very basic questions, okay? So you're their go-to person. They trust you. Literally, you are the person that's providing them their dream. You're the person that's spending the most time with them because you're showing them homes, you're buying them coffee, you're doing whatever. So you're their person. Yes, we're the ones that open their underwear drawers, right, and see all of the crazy stuff. But they still are going to trust you the most. So these are the few questions you really should ask. And I want you guys to write this down, take a snapshot of it, whatever. But this is really important. Are you in the military, or were you in the military, and do you have access to the VA loan? Best loan out there, best interest rates, whatever. If they say yes or no, then that's great. Say, awesome. Do you have any idea what your credit score is? If they say, I haven't checked my credit for 5 years, I have no idea, I can almost promise you they're like at 550, okay? If they say, yeah, I'm at a 740, yeah, I'm at a 630, yeah, I'm at an 800, yeah, I had some mishaps and I'm at a 550, I'm not sure how I'm going to swing this, then they're a little bit more interested and a little bit more invested in purchasing a home. You're not wasting your time. They're not wasting your time if they have an idea of what their credit score is. Do you have money saved up for a down payment, or will a family member be gifting you funds for a home purchase? This is big. Do we ask these questions? Yes, we ask all of these questions, but I promise you this is going to save you time, and it's going to help you pre-qualify the client without running credit, doing all of that. And if they say, you know, I have $1,000, then that kind of leads you to say, okay, well, maybe we set you up with a lender that can get you on a plan so that you can buy a home in 3 or 4 months. Or if they're like, I have $100,000, then you say, awesome, let's get started. You know, I mean, that's just a really good measure. And then you need to prepare them. We prepare them too, but if they hear it twice, I feel like they'll really get it. They need to be prepared for earnest money. They need to be prepared for inspection fees, and they need to be prepared for the appraisal fee. Again, you can't go into purchasing a home and not have any money, even if it's a down payment assistance, even if it's VA. There's still money that they need to have. So make sure that you prepare them for that. I don't want them to hear from me for the first time, hey, do you have enough money for earnest money? Do you have enough money for inspection and appraisal? Because if they're hearing that from me or their lender for the first time, you guys didn't ask the right questions and you wasted your time and they
Yes.
wasted your time, right? So that's it. I'm here for any of you anytime for questions. Again, I have a staff here of 6 of us, and we're all always happy to help. I'll say it one more time, partner up with a good lender. It's like a marriage, and it's like a good marriage if you have the right lender. This is going to be a good year, you guys. It's going to be a great year for all of you. And it's starting off to be a good year for us. And I just have so much belief in Tanya and her teaching and her leading abilities. She's a smart woman. She invests in all of you. Love on her. Take her wisdom and use it. It's good stuff. She coached my whole team, and we got out of a whole rut a couple years ago, and I'm just thankful for Tanya every day. So thank you so much for listening to me.